Hello and welcome to Virtual Investor Conferences. My name is Eric May, and on behalf of OTC Markets, we're very pleased you have joined us for our next slide presentation from Anfield Energy Inc. Before I introduce our speaker, a few points to note. Please submit your questions in the question box to the left of the slides. If you are interested in scheduling a meeting with Anfield Energy, please click on the Meetings tab found in the left navigation bar. You'll be able to view the company's availability and submit a meeting request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Corey Diaz, co-founder and CEO of Anfield Energy Inc., which trades on the OTCQB venture market under the symbol ANLDF and also on the TSXV under the symbol AEC. Welcome, Corey.
Thank you very much, Eric, and thank you everyone for joining us today. I'm here to talk about Anfield Energy and our pursuit of a hub-and-spoke uranium and vanadium strategy in the United States. Safe harbor, please read at your leisure. So a little bit about Anfield. The company has roughly 624 million shares outstanding, market cap of roughly $44 million. The largest shareholder at the moment is Uranium Energy Corporation. We have about 30% of our shares held by institutional investors, and management holds roughly 4 to 5% of the shares. Reasons to invest in Anfield include us having a large portfolio of conventional assets in the United States. Those assets are underpinned by the Shooter Canyon Mill, one of only 3 licensed, permitted, and constructed conventional uranium mills in the United States. We're strategically located within one of the most prolific historic production areas within the United States. We have a good mix of both current and historic resource, which we can certainly upgrade in order to create a significantly long production pipeline. And finally, our acquisition of UEC Slick Rock project earlier this year creates an even greater pipeline with significant resource both in uranium and vanadium. And finally, our aim is to move these assets forward in a way that allows us to use our debt-free status to pursue production relatively quickly. The macro view of uranium is quite positive, given the geopolitical risk inherent in the sector. Clearly, with Russia and Ukraine in a battle, it's affecting the ability to secure material from the east, which affects U.S. utilities who depend on uranium flowing from places like Kazakhstan. We also believe that given that Russia controls a significant portion of worldwide uranium conversion and enrichment, that's also a significant risk, which is forcing Western powers to seek out alternatives. And then finally, China and Kazakhstan have become a lot closer, which means that China is looking for feed for its upcoming nuclear reactor build-out, which means that there will be fewer bits of material which can flow west to U.S. utilities. The government in the U.S. is obviously seeing these effects and is looking for funds to reduce exposure and reliance on Eastern powers for material. That includes both conversion and enrichment. And we've also seen the Inflation Reduction Act has provided an opportunity for reactors in the U.S. to extend lifelines, which we think is significant because that would require even more pounds to be provided to utilities. And so we think that we're well positioned to be a provider as we move forward. Our hub and spoke strategy in the U.S. consists of the Shooter Canyon Mill serving as the hub, with our mines, the Velvet Wood, West Slope project, and the Slick Rock project feeding into the mill over the next 10 to 20 years. You can see in the slide, the yellow dot represents the mill. The blue dots of Velvet Wood or West Slope represent initial feed into the mine, and then Slick Rock represents a longer-term strategy of feed for the mill. In the much longer term, the Frank M and the Filling Tank mines would serve as feed to the mill, but those are vanadium-rich properties. It's much like the Velvet Wood, Slick Rock, and West Slope properties would be. So our core assets, as I mentioned, the Shooter Canyon Mill, we bought this from Uranium One back in 2015. It's one of only 3 licensed, permitted, and constructed conventional uranium mills in the United States, 750 tons per day going through the mill. The Velvetwood project we acquired back in 2015 at the same time as we acquired Shooter. This has historic production of 4 million pounds of uranium, 5 million pounds of vanadium. There's actually an updated resource on this property, 4.6 million pounds of uranium. We haven't put out a resource related to vanadium yet, but we are upgrading this asset to reflect the vanadium content in the project. We expect to put a PEA out, an updated PEA out by the end of this year. We do have a PEA from 2016, which did provide a significant return of between $50 and $60 million. The Velvetwood project, which we acquired from Cotter Corporation back in 2018, represents about 9 mines in Colorado. There is historic resource of 11 million pounds of uranium and 53 million pounds of vanadium. We did put out a resource on 4 of the 9 projects earlier this year, which represented about 25 million pounds of uranium and, about 5 million pounds of uranium and 25 million pounds of vanadium. And certainly we do have the historic resource that we'll be looking to upgrade in the coming months. The aim here is to put a PEA out on those 4 projects, which would represent a significant boost to our feed material that could go through the mill moving forward. And then finally, the Slick Rock project, which we acquired from UBC earlier this year, represents about 11.5 million pounds of uranium and about 70 million pounds of vanadium. So the vanadium endowment is quite significant, not only within Slick Rock, but within all of our Colorado-based projects. And so we believe the vanadium side of the business gives us a significant differentiator as we move forward to production. Enfield's steps to production are threefold. Our near-term production is focused on both using Shootering and the Velvetwood as initial feed into the mill. Given that we do have a PA out for Velvetwood, that makes it relatively easier for us to start there. As we move forward, we'll look to put economics to the West Slope projects, not only the assets for which we have a resource today, but also the other 5 projects on which we do not have a current resource, but certainly we will look to put economics to those as we move forward. And then finally, the Slick Rock project, representing a significant endowment of both uranium and vanadium, would be our focus. And so this would create a long-term life mine when it comes to putting together a production profile related to Shootering and our mines. A little bit more about the Velvetwood project. As I mentioned, we acquired it back in 2015, located in Sangamon County, Utah. The historic production took place there back in the late 70s to early 80s. There's significant infrastructure in place, power, water, roads. So there wouldn't be a great deal of difficulty to move this asset forward. And as we're working today, we're looking to upgrade the mining permit associated with the project. As I mentioned, we're looking to upgrade the PEA to incorporate the value of the vanadium, and our aim is to have it done by the end of 2022. The West Slope project, which we acquired back in 2018 from Cotter Corporation, these are 9 DOE leases, which represent a significant resource endowment, about 11 million pounds of uranium and 53 million pounds of vanadium. It's a historic resource, and we acquired it. Since then, we have put out resource related to 4 of the 9 mines that we believe would be the first to go through our mill. Historic production at the site, 1.3 million pounds of uranium, 6.6 million pounds of vanadium, last produced back in 2006, so relatively recently. The mines are still open. You can see the picture on the top right shows one of the adits for, I believe, JD8, through which we can walk. You'll see material within some of the scoops. You'll see some mining equipment within the mines. So the cost to get this up and running, once again, we believe is quite low, probably less than $1 million. And so we believe that this could be a relatively quick opportunity for us to move into production. There is significant infrastructure in place. As I mentioned, there are adits, underground slopes, open pit, infrastructure, road and power access. And so our next steps here would be to put a PEA out on the projects for which we have current resource, so the 4 projects that I mentioned earlier. and then look to make sure the permits are in place for us to commence production. Our aim overall is to get into production by 2024, and we think that given the resource that we have and the projects that we have and the status of those projects, that would allow us to move forward relatively quickly. The Slick Rock project, as I mentioned, we acquired this from AEC back earlier this year. It has historic resource, significant resource of 11.6 million pounds of uranium and 69.6 million pounds of vanadium. If you look at the picture to the bottom left, our projects are in the blue color and Slick Rock is in the green. You can see how close Slick Rock is to some of our existing projects. So we think that there could be significant synergies when we look to move this asset forward to production. A peer comparison, just taking a look at ourselves vis-a-vis our peers. You can see the projects or the companies, 4 projects to our right. The first 4 do show existing processing facilities. The next 4 show no existing facilities, so would have to depend on third parties for production. You can see that the larger companies, the Energy Fuels, UECs, have significant resource and a market caps significantly larger than ours. Encore Energy, Ura Energy are slightly smaller, but still more than 8 times our market cap. We think that we're in this peer group when it comes to the ability to move forward into production relatively quickly. We think that our market cap should reflect something closer to the market caps of our peers. Even if you look at the parties further to the right, our market cap still is dwarfed by all parties. But we think that that's probably unjustified. We think that we should be trading higher, given the asset base that we do have and the proximity to production that we are currently sitting at. So we think that there's significant upside to our valuation vis-a-vis our peers, and certainly we expect to see that gap close in the coming months as we continue to put news out and advance our assets towards production. Management directors, as we mentioned earlier, a co-founder and CEO, that would be me. I've been in the market for 20 years. I spent a lot of time working on mergers and acquisitions and have created this company looking at buying assets which fit into our strategy of moving forward to production in the relative near term, underpinned by the Shooting Canyon Mill, as I mentioned, one of only 3 licensed, permitted, constructed conventional uranium mills in the United States. Josh Bleak, a co-founder and director of the company, is someone who's been involved in uranium for a number of years, and his family's been involved for generations in uranium, and has been the person on the ground looking for and helping us acquire assets as we go forward. I'll mention a couple of other directors, including Don Falconer, who's both been in private and public enterprise in the nuclear space and uranium. I sat on the board of uranium companies and has run uranium companies. Ken Mashinsky, our most recent appointee, chairman of the company, over 30 years of nuclear-related experience at General Atomics, which owned Cotter Corporation, and has been involved with a uranium producer out of Australia, Quasar, and has been involved in the management committee of ConverDyn. So has a lot of experience that he's bringing to the table to help us move forward to production. So we think that we've got a pretty good team in terms of moving forward to production, and certainly we look to add as we get closer to production status, if necessary. And then finally, these are the other 2 assets that I had highlighted on a previous slide. The Frank M deposit, which sits relatively close to the mill. This is a low-grade deposit for which we will move forward in production once we've gone through the other 3 main assets. 2.3 million pounds of resource at 0.1%. And we can certainly use this as a mix for the mill as high-grade material comes flowing through to the mill. And then finally, the Brescia pipe asset, the Finley Tank in Arizona, has roughly 1 million pounds of resource, but is not one of our priorities, but could certainly help us to extend the life of our mill. And that's the end of the presentation. I see that there's some questions coming through, so I'm happy to take those. So the first question I see is related to the mill. It says the estimated cost to bring the mill, Shooting Canyon Mill, into production. We are working on the cost today. We can't share any particular figures, but we can talk about previous estimates. Back in 2008, a report was put out which stated that the cost to put the mill back into production would be roughly $23 million. Our estimates, generally show about a 25 to 50% increase on that cost. So we think that that's probably relatively accurate, getting to that 25 to 50% premium to where it was back in 2008. Next question. Are you able to access any government programs of support for your projects? Well, we are. We'll get support indirectly through the extension of reactors, funding for the extension of reactors, because the reactors would therefore need to buy more material in order to keep the reactors up and running. I think the second source of support for producers relates to the uranium reserve. So the uranium reserve was put together by the government a few years ago to acquire pounds. Roughly translates to somewhere between 1 and 2 million pounds per year. It's a $1.5 billion undertaking. So there is a way for us to be supported in the marketplace, through selling that material to the government. Next question, would you sell production into the spot market or seek out some offtake contracts? Well, I think this is an interesting question because we have a couple of ways that we can go. Given that we're looking at roughly 1 million pounds per year of production, we don't see the need today to tie that material up into long-term contracts, because we don't think we'd realize the full value of the material signing contracts in the near term. Our view is that the uranium price will go north of $100, so to sign contracts today doesn't make a great deal of sense. Certainly, if we are looking to sign contracts in the future, it would be very limited in terms of the number of pounds that we would sell into a contract. Probably 10% would be the high end. I think if we had an expanded production profile, i.e. if we expand the production available to us at Shooting from 1 million to 2 million pounds, our calculus may change, because we could balance some of that material through contracts and then have the upside tied to selling into the spot market. I think when you look at a company like Cameco, which can produce north of 10 million pounds per year, it makes a lot more sense to contract a lot of that material for the certainty of cash flow coming in the door. But I think given our size, we don't want to limit the upside available to us, and certainly to our shareholders, through contracting all the material. I also think that, given where we are in the market, 5 years ago, the answer would have probably been different, because it would have allowed us to get project financing in place. But today, given where the market is moving, we don't believe we need to signal to the market in that way that we have to get contracts in place in order to get project financing. We believe there's financing out there, and we've had many discussions about financing for the refurbishment of the mill, advancing of the tailings pond, etc., that would not require us to have contracts in hand. Another question, what are the catalysts for revaluation of Anfield? I think there are a few different things. So I think, first of all, our ability to advance the assets that we have within our portfolio. So we're working on putting a PEA together for Velvet Wood, for West Slope, and hopefully down the road we'll have a PEA in place for Slick Rock. Secondly, we are advancing the mill. for its refurbishment. We have two parties vying to become essentially the contractor for that refurbishment that we're working on today. So I think once we're able to put the news out related to having that project finance person or the project manager in place, I think that would make a big difference and certainly provide impetus to investors to jump in with both hands. But I think those are the key things to advance our existing assets in a way that shows the economics tied to those assets and how attractive those assets are. But certainly the second side or the second part is the advancement of the mill in conjunction with the state of Utah. We believe that once that news is out there, I think the market would understand that this is not just an asset which is sitting idly by, but one which would be advanced and ready for production, as we said, by 2024. Another question: do you expect much more M&A activity in the sector? Might you participate in M&A yourselves? Well, I'd say yes and yes. We've seen M&A activity recently. We think that the market is full of a number of small players. We certainly think that there are a handful that can move into production within the current cycle. As I alluded to in my peer comparison, there are only a handful of companies that actually have production capacity and ability. And I would think those are the most likely to be acquirers of other projects. And certainly we'd be looking to participate. We do have a very strong pipeline which could produce 20 million pounds in total or more over the life of the projects that we do have in terms of uranium. Certainly we could produce close to 100 million pounds of vanadium, but we're certainly looking around and having discussions with other parties as to what we can do to increase our project portfolio, strengthen our project portfolio. We did swap out our Wyoming projects, ISR projects, for the Slick Rock project earlier this year in order to consolidate the hard rock assets that we have within our portfolio, underpinned by the mill. So I think that we're not done. We're very comfortable moving forward with what we have, but we're certainly going to be opportunistic to acquire other assets within the sector if the opportunity arises. Actually, one question that I did have earlier relates to where would we sell our pounds, given that Cameco is signing contracts with China Nuclear. Does that provide an opportunity for Anfield to look overseas to sell its material? Well, I think there are a couple of things related to the Cameco transaction. While it does provide an opportunity or open the door and give credence to the ability to sell overseas, I think it also signals to U.S. utilities, domestic utilities, that not all the material that's in North America will necessarily stay in North America. So that provides an impetus potentially for U.S. utilities to seek out pounds from other players besides Cameco, domestic players, in order to secure supply. I think that with China selling or buying from Cameco in North America and also moving towards Kazakhstan to secure supply, those are two avenues which are shrinking for U.S. utilities, which might mean that U.S. utilities become more aggressive to acquire pounds within North America. And we think that we're well positioned to take advantage of that opportunity. And I think those are all the questions that we have. So thank you very much for your time. I appreciate you taking the time to listen to our presentation. If you have any questions, please feel free to reach out. You can see that there's contact information on the slide in front of you. Otherwise, have a great day.